Robert Shiller, the person who predicted the 2007 housing crash before anyone else, has just come out and said that now is a bad time to buy a house and the prices will continue to drop. He says that house prices are still very high and to hold off on buying as the US economy will keep struggling. He also thinks that the downturn is going to continue and it's going to get cheaper after another 6 months. And the whole reason Robert Shiller, the godfather of modern housing economics, is saying this is because he's looking at the data. In particular, he's looking at inflation-adjusted home prices in America, which have come down over the last 8 to 9 months from their peak, but they are still way too high. And in fact, inflation-adjusted prices today are even higher than they were at the 2006 peak of the previous bubble, which was the biggest crash of all time. Additionally, inflation-adjusted prices today are way, way higher than they were in the 1989 peak, 1979 peak, and the 1964 peak. And so if you're a home buyer out there who's struggling right now, you're wondering why prices are still so high, why they're not going down faster, understand that this is normal. Housing downturns take years and years and years to play out. The average housing crash takes 5 years from peak to trough. We are still in year 1 of that housing downturn, so there's more runway to go in terms of declines. And the declines are likely to be steepest in the most overvalued housing markets, particularly the areas in red on this map, where the relationship of home value to income is just way out of whack. I mean, take a look at California. The typical home value of $720,000 is 8 times the median household income. Compare that to a place like Iowa, where the typical home value is only 2.8 times median household income. Clearly, California is going to have a bigger housing crash than Iowa because it's income that fundamentally drives the US housing market. How much money people make ultimately determines the type of down payment they can afford and how much mortgage interest they can afford to pay on an ongoing basis. And so if prices go way above the level of incomes, you know eventually they're going to have to come back down. Now, another option is that income and wages grow to meet the higher price levels. And that's something that actually occurred in the 1970s, in the great inflation of the 1970s. One of the reasons the housing market did so well back then was because Americans were making lots and lots of money and their income growth was huge, registering anywhere from 7 to 10% per year for a decade. And all of that income growth led to huge levels of personal savings. I mean, take a look at this data, folks. In the 70s, the personal savings rate in America, the average amount that families were able to save after spending money was around 10 to 12 to 13%. So people had a lot of money back then to spend on housing, to spend on rent. But then fast forward to today, where the personal savings rate is anywhere from 3% to 4%, near the lowest levels of all time, a signal that Americans don't have enough money to support the housing market this time around. And really, that's the dirty little secret that realtors and real estate investors and a lot of the mainstream media don't want you to know as a home buyer. They don't want you to know that it's income and savings that fundamentally dictate where the housing market goes. And they don't want you to know that there's not enough of it to keep the housing market supported. So that's why you see so many false narratives, so much propaganda being spun right now about how the housing market is recovering, about how home prices are going to keep going up. It's a bunch of crap, everyone, because income is what determines home prices in the long run, and the incomes aren't there. Especially in light of this recession that's unfolding in 2023. I mean, the white collar layoffs are getting even more severe with each passing day. And additionally, the wage growth in America seems to be stagnating. One of my favorite things to do to just understand this, to get a sense of what a regular American is feeling and dealing with, is to just go on Indeed, the job search website, and see the type of jobs that are available. Right now, if you're in Miami, here are the full-time jobs you can get. You can become a medical assistant at a cancer institute and make $18 to $23 an hour, which would be about $40,000 a year. Or you become a claim specialist for the Social Security Administration and make $45,000 a year. Or you could become an insurance collection rep and make $16 to $19 an hour full-time. And so yeah, most of the jobs on Indeed in Miami full-time are hourly and would get you anywhere from $40,000 to $50,000 a year if you were to work them full-time, and that's just not enough money in a metro where the typical rent for an apartment is $2,800 a month. You can see here that a couple years ago it was around $1,800 a month to rent an apartment in Miami. Now it's $2,800 a month, and the incomes have just not kept pace, with the typical family in Miami now needing to spend 50% of their median income to afford rent. And so folks, none of this is sustainable. I mean, the people who are holding out thinking it is, I mean, what are you looking at? What data are you looking at that says to you that it's a good idea to buy a house right now, or that it's a good idea to be an investor and try to rent out a property when the tenants in your city are having to pay 40 to 50% of their income to afford the rent? Like, that's only going to end in one way. It's going to end in evictions. It's going to end in defaults. And in fact, we're already seeing this occur. There's a big surge in evictions going on right now all across America because tons of tenants cannot afford the rent with how much the rent has gone up over the last 2 years. Data from Eviction Lab shows that in metros like Miami, the eviction levels are back up above pre-pandemic levels. Same thing in Las Vegas, where evictions are now up 81% from average. And these evictions are now leading to a big surge in vacant housing units and vacant apartments. If you go on Zillow, you're going to see a lot more vacant houses for rent. You're going to see, if you're looking at an apartment building, there's going to be a lot more selection for you if you're a renter in an apartment building. And this is causing rents now to start to go down across America, which is a big problem for landlords, because declining rents and increasing vacancy rates means they're not making as much money. They're starting to lose money from what they were making during the pandemic in a time period where interest rates are going up and a recession and layoffs are on the doorstep. So a lot of these real estate investors are going to get wiped out and flushed out as this recession and housing crash unfolds. But if you are a real estate investor, I think there are certain areas of America where you could buy and be more protected. If I were an investor, I would personally target housing markets with the highest cap rates. These would be the areas in red on this map. A lot of them in the southeast where the cap rates are around 8 to 9%. There's a bunch of markets in the Midwest where the cap rates are around 7 to 8%. Higher cap rates means you get more cash flow from day one from your rental property, which means you're less reliant in the long run on appreciation and rent growth to make your investment make sense. Additionally, those housing markets in the southeast and Midwest are also much more affordable for local home buyers. So if you are an investor, you're not doing as much damage to people's home buying prospects if you buy in those cities compared to more expensive ones on the coast. And if you're an investor or a home buyer and you want to access that data, you can go to www.reventureapp.com. There's historical cap rate data for every metro in America going back 7 years. And really, folks, I gotta say, my whole inspiration for Reventure App and bringing the data to you on the US housing market comes from Robert Shiller, the economist we talked about in the beginning of this video. The fact that he's saying hold off on buying a house is a huge deal. Robert Shiller literally laid the groundwork for understanding the housing market. Back in the late 1980s, he developed the first system for tracking home prices in America called the Case-Shiller Home Price Index. Additionally, he was the first one to call out the housing bubble in the mid-2000s. In 2004, he wrote a paper called "Is There a Bubble in the US Housing Market?" And the whole methodology he used to predict this bubble was the fact that home prices went way above income levels. You could see he had these graphs back in California and Massachusetts which showed the bubbles there, but then he identified how Wisconsin wasn't a bubble because the relationship stayed stable. And that's the exact same methodology that I used in these videos starting 2 years ago that allowed me to predict this housing bubble before anyone else, and it's the methodology that you guys have access to for free in the Reventure app. And just going back to this map of the value to income ratio, the most overvalued housing markets in America, I mean, let's just take a look at Florida. The value to income ratio in Miami right now is 6.7. The typical home value is 6.7 times the median household income. That's way above the long-term average of 4.5, which shows you it's a housing bubble. What's even more concerning is that the peak value to income ratio in 07 in Miami was 5.7. It was actually lower. Miami wasn't in as big of a bubble relative to income back in the mid-2000s, and then there was a big crash. So if you're a home buyer and investor looking at this graph in Miami today, I mean, how could anyone actually say it's a good idea to buy with a straight face? Same thing in a market like Phoenix, everyone. The value to income ratio today in Phoenix is 5.7x, which is way above the long-term average of 4.4 and is comparable to the peak that occurred in 06 in the last bubble before prices crashed. So again, I'm seeing some people now say Phoenix is having a housing market recovery, it's a good idea to buy. No, I don't think so. Things still have a far way to fall. But not all cities are like this, everyone. Not all cities are gonna have a big housing crash. In particular, like a lot of areas in the Midwest are just more fundamentally supported and aren't gonna see prices go down as much. If we look at Pittsburgh, for instance, the typical value to income ratio is 2.7, means it only takes 2.7 years of median income to afford the typical house in the metro. As well as down in pockets of the Southeast, like Little Rock, Arkansas, the typical home value is only 3.1 times the median household income. And so those those markets are not going to crash as much. It doesn't mean they're not going to see prices go down. There's still going to be a correction, but it's not going to be like this major crash because quite simply, the local home buyers still have some money and are able to afford the prices. One thing I would encourage you all to do is to use Reventure app to actually see a list and a ranking of the most overvalued housing markets in America. You can do that by going to the drop down and hitting over undervalued percentage, restricting the list to metros with populations of only 100,000 or more, then going to table view and seeing the most overvalued markets as well as the least overvalued markets.